When you go out and you invest in a company like Amazon, you're investing in one individual company and you're taking on all the risk. And this is what most people think stock market investing is trying to find the next hot stock. But for 90 to 95, maybe even 98% of people, you should not be investing in individual companies, because when you invest in an individual company, you need to be keeping up with the company. You need to be keeping up with the earnings calls. You need to be keeping up with the finances of a company. You need to be keeping up with what the company is doing on the innovation side. You need to be keeping up with the moat of the company. How easy is it for competitors to come in to compete with this company? And if you're not interested or not willing to or don't have the time to do so, you probably shouldn't be investing in individual companies, because then when you see a company that you invest in go down and you don't understand what's going on, it can be much easier for you to panic and sell, or it can be much easier for you to go in and buy because you keep hearing the stock go up. And this is where now understanding if you are interested in actually doing all that work and taking on that risk, because the reality is when things are good, you get all the benefit. If Amazon takes over the world and you own the Amazon stock, hey, you're going to make a lot of money because the Amazon stock is going to go up. But if the CEO of Amazon drives the company into the ground and they go bankrupt, you lose all of your money, because now your money goes down to zero. And that risk can be a really hard pill to swallow for people, especially when things are going down, but it's very easy to understand when things are going up. But the alternative is, instead of investing in an individual company, you can look at investing in a fund. What are these funds? Well, you have index funds, ETFs, and mutual funds. The way the index funds work is these are what are considered passively managed funds, meaning they give you exposure to a certain group of stocks which is managed by a computer, which means that the fees that you pay on these funds are significantly lower than when they're managed by, say, a person. So there are index funds that give you exposure to something like the S&P 500, which is a group of the largest 500 companies on the stock market. And if one of the companies in this fund starts to struggle and they're no longer one of the 500 largest companies, a computer can kick that company out and put a new company in, that way it's all automatic. So you have index funds that can give you exposure to many different types of funds, like the S&P 500 is one. There are index funds that can give you exposure to the Dow Jones. There are index funds that can give you exposure to the NASDAQ. There are index funds that give you exposure to healthcare stocks. There's a lot of different types of index funds out there, but these are generally passively managed, so the fees are less. The second thing about index funds is that there are restrictions to how often an index fund trades. So if you wanted to go out and buy the Amazon stock, you can buy and sell that stock in a second. Versus with an index fund, they generally only trade one time a day. This way, you don't have that same volatility, and you can't have people just buying in and out of index funds. You can buy it or you can sell it once in a day, and that's it, because these are long-term investments. And the third thing you have to understand about index funds is that they generally have minimums of how much money you need to invest in order to purchase an index fund. It might be $500, it might be $3,500, it might be $5,000, where you have to invest a certain amount of money in order to own an index fund. A mutual fund works kind of like an index fund, except mutual funds are generally actively managed. So now, instead of having a computer manage and create the algorithms, with a mutual fund, you generally have a person, a money manager, who is working to try to beat the market. Now, this might sound good in theory, but many times this higher fee is not going to justify the returns that you get. Because what we've seen happen over the last decade, Moody's did a study, and they found that about 75% of the time, a high-paid money manager managing the mutual fund did not outperform the market. Meaning, if you just bought a low-cost fund, you would have gotten a better return after factoring the fees. So, is a mutual fund ever worth it? No. Just understand that the higher fees are going to make it less attractive, so you want to pay attention to the fees. Mutual funds also trade generally one time a day, and they also generally have a restriction on how much money you need in order to go out and buy a mutual fund. Then you have ETFs, which are kind of a hybrid between index funds, mutual funds, and stocks, because ETFs can be either passively managed or actively managed, just depending on whatever the ETF is. But the big difference between ETFs and index funds and mutual funds is that ETFs trade just like stocks, meaning you can buy in and out of an ETF as many times in a day as you want because they trade just like stocks. So if you want to buy an ETF in the morning and sell it in the afternoon, you can do that. And generally, ETFs don't have minimums of how much money you need to invest if you want to actually own an ETF. So what is the right thing for you? Well, this just depends on what your goals are and what you like. Me personally, and I can't tell you what to do. You got to always do your own due diligence and never blindly trust a random guy on YouTube. Don't do what I do. I'm just telling you what I do. I personally like ETFs because they're the most convenient and they're easy for me to purchase and they're easy for me to sell. And I like that convenience factor with ETFs. So for me, I like ETFs. But this is where now you have to understand what is your goal when you invest your money. Because for me, I like cash flow. Cash flow means that when you put your money into this thing, yeah, you want this thing to go up in value, but it's also paying you while you wait. And in the stock market, this payment is called a dividend. A dividend is when a stock pays you money for doing nothing except owning the stock. Not all stocks pay dividends, but some stocks do. And if a company is paying out a dividend, this means a few things that you want to understand. Because number one, it means that a company is making a healthy profit. And now, if a company has this profit, they can do three things with this extra cash. They can save this money for an emergency or a rainy day. They can invest this money back into the company to invest and open more stores, to invest in research and development, and to help grow the company. And the third thing that they can do if they don't want to invest this money back into the company, or if they don't want to save this money, is they can give this money away to their shareholders, meaning the owners of the company. Meaning people like you. If you own one share of a company, you are one of the owners of the company. And if they give this money away through the form of a dividend, that literally means they're going to give you a check or they're going to deposit this money directly into your brokerage account, which is a payment that you get for doing nothing except owning the stock. Now, this can sound good for you, but it has its pros and cons that I want you to understand because number one, this means that generally a company's stock price won't grow as fast because now instead of using their money to grow their company and grow the valuation of their company, meaning grow the stock price, they're just giving it away. Second, this also means that you have to pay taxes because when you get paid, you have to pay taxes. And so now when you get paid a dividend, there's taxes that you have to pay on that money, even if you automatically reinvest that dividend. If you get $1,000 worth of dividends and you reinvest all of it back into the company, well, you still have to pay taxes on that $1,000. So something you have to understand, although the tax rate that you pay on qualified dividends is the lower capital gains tax rates, meaning generally you get a lower tax rate on your dividend income than your income that you get from your job. So it makes up for that. But this is where now you have to understand, what do you want to get from your investments? Do you want cash flow or do you want to see more growth in the stock? Because if you're investing in a growth company, like a startup company, they're not going to be paying out dividends. Because if a startup is paying out dividends, that means that they're using their money not to grow the company, but just to make their shareholders richer. And if you're a startup, you want to go out and get bigger. You want to get more of the market share. You want to get a bigger share of the bigger pie out there. And that means you got to use your money to grow quicker and faster instead of just trying to make your owners richer. So if you want to see the big growth in a stock price, well, then you're probably not going to be investing in the dividends. If you want more slow and steady growth, then dividends can be a better option for you because you also get that cash flow. And this is where you got to find the right strategy for you. For me, I like cash flow. That's why 75% of my investment portfolio, not my stock market portfolio, but my total investment portfolio are cash flow producing assets. And in my stock market portfolio, I have a lot of ETFs that pay me with cash flow. And I own some companies that also pay me with cash flow. Because for me, I like cash flow. Most of my investments are cash flow producing. Are all of them cash flow producing? No. But most of them are because I like that cash flow, because the advantage of this cash flow is you can go out and buy this thing and it will continue to pay you even when you're going out and sleeping or you're going out on vacation and you're going out and traveling, you're continuing to get the cash flow. For me, I want to have a system where my cash flow is funding my life. That way now I don't have to worry about my money because I own assets that are paying me with cash flow. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.